Welcome to the Broken Pie Chart Podcast, episode 352. I'm your host, Derek Moore. With me once again, Shane Skinner, Mike Snyder. All right, so nothing happened this week. There was no volatility. Bitcoin didn't go down, and the Fed didn't say contradictory things. So, Shane, first with you, what is going on with Bitcoin? It's down, obviously.
Yeah. I mean, it's down quite a bit. We are right at the close, about 18.5% below the 200-day simple moving average. So for most of the people that have any inkling on technical analysis, right, the old saying is nothing good ever happens below the 200-day. And so far, that's holding true.
I mean, if I look at the retracement from the high, and I'll use IBIT, and there's other ETFs that track Bitcoin, but it's on my screen here. I mean, the high was what? October 1st, and it's down like 33%. So it's in a quote unquote bear market. It's above 20%. Here's the thing, Mike, do equity traders care at this point? Or is this just is it a problem because this creates issues elsewhere? Like, I don't know. I mean, I know we were saying last week, this is sort of what you get when you have all these ETFs, because typically investors, when something's going down, there are flows out of it. So, I mean, does this surprise you? We're seeing this?
It doesn't surprise me that we're seeing a sell-off. I mean, it's still up a significant amount, right? It's not year to date, but it's still performed well over the last few years. So, I mean, this is the type of asset that's going to have volatility like this. It is surprising to me how correlated it just continues to be with the markets. We saw Nvidia pop after earnings, and I took a look at Bitcoin, and it was also up. And I'm just thinking, like, why is it so correlated and moving like that with the market? Is that a concern if you're really a Bitcoin believer in its actual, end user use, that it's so heavily correlated, at least recently, with the markets?
Shane, one of the things that came up is MSCI is an index. And I think there was an article, it might have been JP Morgan. I think it was JP Morgan. I'm sorry, JP Morgan, if it's not you, whoever it is. And they said that MSCI, and this is a kind of not really quoting because I don't have it in front of me, but it was something to the effect of they might remove strategy, MSTR, from some of the indexes. And the article went on to say, well, if it comes out of an index, if you have ETFs that are passively following that index, it might have to liquidate. But that, Bitcoin isn't in an index. And Bitcoin and strategies prices are definitely correlated. I don't know, Shane. I mean, I don't think strategy is selling Bitcoin. Like, selling strategy, the stock itself, doesn't necessarily cause Bitcoin to go down unless people are like, oh, that's going to cause them to have to sell Bitcoin. I don't know, Shane. Anything there? I don't want to spend too much time on this. But am I getting that?
I know this is your favorite subject to talk about.
It's really not.
I know that crypto is, if you could spend all day doing it, you would.
Nope, not true.
So the MSCI thing is interesting. I saw something similar again. I think I saw it in passing on X, but it said something to the extent that they're weighing a rule that could exclude companies with balance sheets holding over 50% in digital assets from some of its major indices. So, that's not just strategy. If that's true, that's going to affect or be affected by this. It's quite a few of the other players in that space, especially like digital asset treasury companies, because that's all they hold for the most part. So I think that we're seeing an example of how the almost like contagion and the interconnectedness of things being in funds, and if certain things get liquidated, it affects the fund. If the fund gets affected, it affects this and that. But really at the end of the day, it's just a very odd situation, I think, to find ourselves in, where you're basically flat, if not down, on something like Bitcoin or strategy, right? If you had bought at the beginning of this year. And I think we're now pretty close to being at or below where we were at prior to the last election result. I know there was a lot of talk about this being a very pro-crypto administration. And so I just think there's a lot of confusion going on in this space right now. No one really seems to have any idea what's going on. But I'm with you. I don't think strategy is necessarily selling right now.
Well, to go back to what we've been talking about on the last few shows, it's that you do have retail flows. I mean, I looked at there's a screen in Bloomberg where you can look at the flows for ETFs. And something like IBIT, not surprised, they had flows out. They had their big flows in at the highs. And that's just how sometimes retail investors act. Retail investors also were voting with their buys and sells in Nvidia this week. And we looked at Nvidia prior to earnings. Nvidia prior to earnings had a 103. Hang on, let me get the implied. Yeah, about a 103, 104, 105 implied volatility. And this was right before earnings. By the way, I just did a hard transition there to get away from the Bitcoin, if you didn't catch that. So 104 divided by 15.875 is about 6.5% was the expected one-day move. So we know it popped at the beginning. It was 186.80, closed today where? 178.88, something like that. The straddle was $14. So, Mike, if you sold the straddle in this case, remember last week I said I'll let you know whether you should be a seller or a buyer of the straddle. Apparently, you should have sold it, right?
Yeah. Oh. $14 straddle. That would have been a nice trade.
Because 14 minus 186 is 172, and it 178, 179 at the close, right? So it was inside.
Yeah, exactly. Not sure that I would have done that.
Nor would I.
But yeah, that was the right move. So market pricing in, and it did pop. So it depends. Hopefully if you did that, you held it, because it did pop up to 195, and then we saw it sell off throughout the day and into part of today.
I mean, Shane, when you look at Nvidia. And I don't remember if we talked about it on the show last week or we just talked about it, internally amongst ourselves. Like, it wouldn't surprise any of us if, it was kind of more like unchanged. The move up that next day was pretty powerful though. And obviously we've settled back down below the close. I don't know. Like, this was a really good earnings report, Shane. Really good.
So it was. The other thing that's really interesting, you guys described, the upper bound and lower bound as sort of where we traded after earnings. And it was kind of like the width of the straddle. Like, you see, we kind of got up to the upside about 14 points, give or take, up there, 15. And then the same thing to the downside. And it caught support to the downside and held above, right? And found resistance above that. So I think, again, you come back to like these expected moves and what gets priced in beforehand. If there's a lot of money on the line with an initial position trading that straddle, then those are key crucial levels. It's not that surprising to me that we ended up basically trading the range of the straddle and then settling somewhere in between. So, that was interesting. In terms of the earnings, I think everything was a beat. Everything came in above expectations, was fairly solid. I'm actually more focused on an announcement that took place today than I even am on the earnings. Well, I guess you could tie it into the earnings, and that is that President Trump is considering selling the H200 chips to China, I believe, if I understood correctly. So there's been a ban, right, on selling NVIDIA chips in China, more or less. And so in all of NVIDIA's forecasts, all their earnings and everything they've been reporting, Jensen essentially said this has zero expectation of any sales in China what we're forecasting, what we're doing right now. And so to open up the floodgates and resume trade of those products, I mean, if the demand is there, this could be huge. So I think it's not just the good earnings setup. I think it's news like this today that came in. I wouldn't be surprised if the market catches a second wind, but we'll see.
I just took a look at the volatility, implied volatility for next Friday's and next Friday's expiration, 57. So we went the day before expiration, it got up to 105. I think I remember the week out to earnings was what, like 75 or 80. Now it's down to 57. There's that volatility crush. It's, Shane, you mentioned that obviously the chips, because all of these results recently, this recent quarter, I mean, that excludes sales to China. So that's an interesting point. On the flip side, I listened to a podcast on excess returns with Rob Arnott from Research Affiliates. And it's a really interesting podcast. And I've been, when was I? I saw him speak in person at the CFA Society dinner in Scottsdale, I think in the spring. And he's made this point that there is a lot of CapEx spending, but there's not necessarily the return on the investment yet from all the CapEx spending. So, Mike, I mean, do you agree? And if so, what are you buying or selling right now? I'm kidding. I mean, I think it's really early to call this, though. Like, this is really early.
Yeah, I mean, it's a good point, but I think that's pretty known, right? I don't think that the market's looking at the CapEx and saying this needs to earn some immediate level of return. I think the market's looking at the potential return in the future and what that could look like. So, like you said, I think we're really early. It's a good point that the return right now might not be there, but I don't think the market's overly concerned about that. Do you?
I mean, so far, not really. I mean, we all of a sudden the CapEx spend came under scrutiny or question, but yeah, I mean, look, the earnings estimates are still higher. And I always go back to the analyst. I mean, Shane, when you look at the analyst expectations, they are moving higher. And it's this weird thing where Nvidia has actually gotten cheaper. Now, I'm not telling people to buy it. If you want to buy it, buy it. If you don't want to buy it, don't buy it. If you want to short it, remember, you have unlimited loss to the upside because stocks can go to infinity, although never any stock that I owned. Shane, I mean, I don't know. I mean, early, too much caution on this, not enough.
I think that this market is in a really odd spot because it's like we're going through these periods where these certain things matter and then all of a sudden they don't matter, right? Like the tariff thing has seemed to have run its course. Like I don't think tariff news at this point even affects the market. I mean, it could, and I'm not saying it won't, but it's almost like the market's outgrown it and it's moved on to focusing on other things where it wants to maybe see some more certainty. I think that a spotlight has been finally shined to sort of the overall broader market and the participants within it on sort of what's going on here in the AI space, especially with the depreciation stuff. And at the same time, I feel like we're in this environment that it's almost like there's a ton of gamma and positive and negative news with respect to AI. Like all it's going to take is a couple of companies, whether they're small cap, mid cap, large cap, coming out and showing that they've found a way to really improve margins and generate profit via AI. And like once those start popping up, I don't think you're going to be able to kill the argument that, you know, this AI thing is big, right? Very big. It's the next big thing potentially, right? But
it's big. The question is, does it help the companies that are spending all the CapEx, or does it eventually accrete down to everybody else?
And that's the question that I don't think anybody knows. If people are placing their bets on either side of where they think that's headed, I think.
Well, Rob Arnott from Research Affiliates, I think in that same podcast, if I heard it correctly, he compared this to the internet bubble, or the internet boom, I should say, and bubble, or whatever you want to call it. And I think his point was, and it's what I've been saying, if you follow new technologies, there's these booms, these busts, the standards are set, all of all the technology then is available, but it's not necessarily the early people who created it that made all the money. It's how it accreted back to businesses. So, yeah, I mean, we'll see. Mike, the other thing this week is I feel like every Fed governor, aside from Powell, talked. And we're fixated on these interest rates. Shane, to your point too, we're fixated on something. This week it was the AI trade. And then all of a sudden, Williams speaks today. I mean, Mike, you were following this, right? Williams said what?
Yeah, he gave some more dovish remarks that he could see an interest rate cut in the near future, when I think markets were becoming uncertain whether that was going to happen. And I think we saw that, small caps had a pretty tough week, as I think the belief started to grow that interest rates may not get another cut here in December. So this news, with those remarks, I think gave the market a little bit of a pop today. You had IWM up 2.8%.
I mean, small caps is always that's been the bet. If you think interest rates are coming down, you go to small caps. And the theory is that they are the most affected by financing costs because these companies have to access capital markets, and they're not Apple. Like Nvidia and Apple could probably, if they needed to raise debt, they would go and get some of the best terms that there are. I mean, that trade has been good. I mean, IWM, you mean the Russell 2000, Mike? Like took a while to get all-time highs, but Mike, that's been doing fine.
Yeah, it's come back.
Good way to put it. Yeah.
Yeah, it's come back. I mean, there was a period there where, and I can't give you the exact range, but it seemed like it was lagging in a really strong market. But it has rallied back nicely. Like I said, it's off its highs like everything else is, but I think it being up, just south of 3% today is a good indicator that, the market is more confident that there's some interest rate cuts in December coming.
Shane, we often get questions about, should I wait? Should I wait? Should I invest now? I feel like people still have been so skeptical of this market. And what we always tell people is, we don't try and time it. The core thing we do is we buy and hedge, we buffer. I mean, we do a lot of other stuff too. And if you want info on that, hit me up at derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. You're going to have to figure out how to spell investments on your own if you want to get through to me. And send questions. I think we got questions, but I didn't remember to bring them in, Shane. So
it's been a busy week. The market kept us busy, right?
So Sam Rowe, yes, it is. And I want to talk about year-end targets. Of course, we'll do our prediction show for 2026 for everything that could or couldn't happen. 7,100 is Oppenheimer, apparently. Let's see when this was. Oh, no, this is July. Okay, now I'm totally confused. Sam Rowe had retweeted something from Josh Schaefer. 7,100 is back on our list of year-end targets. Yeah, this is null and void.
It's
an old one. It's from July. They totally faked me out. I'm like...
Maybe he's trying to say himself he thinks that. But I mean, it's interesting how we bounced off the 100-day today, and the indexes, we closed, I think, right around it. on the S&P and the NASDAQ. So if you're looking at it from a very basic technical standpoint, you're sitting on the 100-day. This could be a violent rip higher. This could be a violent rip lower. We could run sideways for another month into December, and then some decision get made into the end of the year. But it's tough to time these things, like you said, and it's probably not worth trying. I think statistically it's been proven that you have to be very, very good to be able to time it. And even then, it's probably still luck at times. It's a weird spot to be in the market right now. If you're not hedged, hedges are now much more expensive after the recent volatility and shakeup. If you are hedged, you're probably a little bit more comfortable continuing to sit, maybe still buy, because again, you're hedged. But
we've got a couple people that hold maybe the Bitcoin ETF, and then we hedge that. And it's interesting because it's come down so much. There are some positions that it's actually in the hedge zone, and it, in some ways, it makes the decision. Do I stay? Do I go? I mean, of course, this is things that people have to figure out. I want to ask though, Shane, this is Charlie Bilella had tweeted something out. I guess they said, so minus 5.8 was the decline from October 29th to the 21st. So not quite 6%, according to, this is from Charlie. Minus 21.3%, February to April 7th. We had minus 9.7%, July 16, 24 to August 5th. 5.9, March 28th to April 19th. I'm reading these off because I could read a bunch more. Like, these declines happen, Shane. And I mean, look, we're still after today, we're closer. But as of the close yesterday, we were within 6% of the all-time high.
Yeah, no, 100%. This happens in upward trending markets, just like the reverse happens in downward trending. I don't have the numbers now. I'll get them for the next podcast.
Yeah, get them right now. Go get them. I'm kidding.
It's really interesting, though, because Dr. Burry tweeted out a couple of years back during 2022. I remember him specifically talking about bull rallies in bear markets. And, there was something like 15 plus 10% or more rallies in the time span between the high of 2000 and the low in 2002, I believe, from the NASDAQ bubble, right? Or the .com bubble, as we should call it. That, to me, these until something fundamentally changes in this market really turns, it seems like all these 5-10% down moves have just been great opportunities for people to come in and buy the dip. And that's sort of what I was getting at earlier with the news thing was, you find yourself sitting on the 100-day moving average, and then it just gets announced that Nvidia can potentially resume selling chips to China. And now you're sort of forced to make a decision here. Do you want to fight it still and say, okay, even though Nvidia is probably going to have even better numbers next quarter because of this, and things are going to get even better, it feels like this is a really hard market to fight. It feels like a lot of people want to fight it. It's a hated rally. It is. And I don't know. It's something fundamentally hasn't broken yet, I think, to justify the turnover.
Yeah, I mean, there's always a reason.
Right, there's always a reason.
There's always a reason.
So,
all right, Mike, I'm going to have you bottom fish for a second. What is it, energy? Have you seen oil prices? They're down. What was crude today? Like 57, 56? Would you rather own energy? Would you rather own, what's the other one that's down? Consumer staples? Is that down? What's the symbol on that ETF? I forget. Like, energy has to be the most unloved here, though, right?
Yeah, I mean, it's been like since it's recovered since that April bottom. Certainly, it's up from there, but It really hasn't done a whole lot in the past, year? If you look back to like a year ago today, it was higher than it is today. It's down, and I'm looking at XLE, the energy ETF.
Mm-hmm.
It's down $8, which is about 9% in the past year. Yeah, I wouldn't mind having an allocation to that in the portfolio. It's not something I'd be overweight to, but it's certainly something that's underperformed.
I mean, if you look at staples, I did have to look it up. IYK, is that the iShares U.S. Consumer Staples ETF? So, yeah, I mean, its high was 73.25. It's currently 68.74. It's rallied though. I didn't realize it rallied off the lows a little bit. But yeah, I mean, this is why it's hard to pick sectors too, because sometimes you're kind of like, well, I'm going to bottom fish. And you might buy, I don't know, you might buy gold, you might buy oil. Well, not gold. Gold's at the top. I'm not saying not to buy gold or buy gold. I'm not giving you either one.
I'm going to make the argument gold. This is a weird one. You brought this up about 2-3 months ago, Derek.
I did? Okay.
You brought this up. This is the first time, and I think 100+ years of data where oil has been down and gold has been up this much in the quadrant. We'll have to find that.
So who's wrong? Who's wrong? You gotta. We always say, by the way, this is an internal joke because when the markets are down and we look at high yield and we look at the S&P and we're kind of like, okay, who's wrong? Because normally if it's a systematic thing where everything's going to go down, you would expect high yield to go down. So flip a coin, Shane. Who's wrong?
I mean, if we're looking at this chart, right, since 1970 and on, probably back to 1950 more from what I see here. When you ratio the two, we've not really had any real crossovers where gold crosses above oil, other than the brief period where oil went negative in 2020, which what a fun time that was. This is weird. I mean, you're talking 50 years of data here, and not once has gold gone parabolic, basically, without oil following it, more or less. So for oil to be down so much and gold to be up, it doesn't necessarily mean anything, but it's odd.
Look, everything, this is why you say, well, it's never done this and never done that, and it can.
Absolutely.
If I look at earnings, though, and I look at the 2026 earnings growth, EPS growth contribution by sector. This is from a chart pack snack put out by State Street. And you look, I mean, tech expected 4.7%, financials 1.7%, industrials. And then the lowest earnings growth, well, I mean, you have energy 0.4%. This is percent. The worst one is real estate, 0.1%. I mean, I don't know, Mike, you brought up rates earlier, and I looked, it's about a 76% chance the Fed lowers interest rates now in December. So 77%, and then it's basically 100% probability based upon where the Fed funds futures are trading that it'll be minus a quarter point by. So I don't know. I mean, you've been following this a little bit more than we were today, Mike. From what they're saying, are they trying to tell everyone, hey, guys, we got you. Market's down. Stay good. I mean, is that your read on this?
That's kind of how I read it. I don't know that you usually get someone that comes out like this and gives remarks that were this dovish. But that's sort of how I took it, and I think that's how the market took it.
I think you're right. I mean, here's the other thing, Mike. We've been saying that this Fed, and when I say this Fed, it's under the Powell regime, they have not surprised the markets. They really haven't.
No.
They've really telegraphed everything that they're doing. The only time, Mike, what was it? The when we weren't sure if it was a 25 or a 50. Remember
Right.
that one?
Yep.
That was sort of that one period there. If I look next week, there's nothing. Not surprising because it's a holiday week in the US. Thanksgiving, the beige book comes out. But yeah, they were quite a bit. And then if I go and I say, we look at the first week of December, well, they're probably in the blackout period because they're not allowed to talk too close to the meeting. But I'm just kind of curious if they're talking in, so the blackout is the 29th to the 11th. So Mike, think about it this way. Is that like the last salvo that came out of somebody from the Fed? Like, hey, we're open to it. And then they go blackout period.
It seems like it. Like they didn't want to go into this blackout period with this uncertainty hanging over the markets. Like you said, they haven't surprised really, and I think that they're sending another signal here. They don't want to surprise anyone, and this was sort of their last chance to get their message out. It seems like that's what they did.
I mean, Shane, I remember having lunch with Mike Aroni, the chief strategist over at State Street, and I think he calls them what, the chief. The plunge protection team, meaning if there's a market plunge, like the Fed has been coming in.
Yeah, yeah, absolutely.
It's still real, I think.
Yeah, no, absolutely. And I'm gonna make a statement here that
oh boy,
it's my take, right? I think we're in a situation where there's a lot of uncertainty about a lot of different things. It's almost like no one even knows really what to.
Boy, that's lazy. There's always uncertainty about stuff.
Wrong. Right. There's always uncertainty. And so, I make the argument, the more people start to think or really look into everything, the more people might start to panic because, again, they don't necessarily know where to look. Like we said, 1 month this matters, the next month all of a sudden this is what's important and what the market's focused on. And so I think what's going on is, we just need to sort of like foam the landing strip a little bit so that we get into QE, the Fed can get into doing QE without anything really falling apart. And I think if we can do that between now and then without having a huge pullback, a huge scare, because I don't know about you guys, but I would consider, crashes in the market sometimes or big pullbacks in short periods of time. It's almost like a bank run, right? If everybody starts freaking out all at once and exiting the market all at once, that's when you have issues. And so if everybody kind of stays calm, if everybody stays cool, and we can get a couple months more ahead of where we are now, maybe QE resumes, that Fed puts sort of in place because of it. If there are any liquidity issues in certain spaces, they're there to really help because they're printing now. I don't know. And again, I think that this Nvidia China news, I think it's way bigger than most people realize initially, and could be huge tailwinds going into the new year.
All right. We're going to go a little shorter today. The last thing I'll say before we get to our normal ridiculous recommendations is that there's a couple periods that this kind of what the environment we're in now really reminds me of. It does remind me in the late 90s. In 2012, 2013, it reminds me of then too. And the reason why it reminds me of that is the markets have had a couple good years here. The market's doing well this year. I mean, it's up. I know we've had the April retracement. We've had this little retracement here. Mike, we were talking off air. I mean, I remember in December of 18, that was like the bear market that nobody remembers. It didn't quite get above 20% on a closing basis. But it just reminds me of periods where the market was doing well, but what people were thinking about the market and the economy, it's kind of a disconnect. And I guess all this will get worked out at some point. But let's go to recommendations. Shane, to you first. and you get one recommendation.
Yeah. Oh, hey, I'm getting better at this. Okay. I'm gonna go with the recent movie released on Netflix, Ballad of a Small Player with Colin Farrell. I guess it's based on a book. I have not read it, but it's essentially about a guy who's up to his neck in some debts, and he's playing cards out in China, and he just sort of he's trying to get his life in order. I don't want to give too much away, but it's a really good story, kind of an underdog story. It's solid, strong recommendation.
Strong recommendation. I like it. Conviction list. Mike, what do you have this week?
I'm going with something I haven't even watched yet, but I know it's going to be good.
Pre-recommendation. Nice.
I know it's going to be good based on what he's done in the past. If you like stand-up comedy, Sebastian Maniscalco, little plug for him, like he needs it, has a new special coming out on Hulu called It Ain't Right. So I'll be watching that this weekend. He does a lot of comedy around, social situations and family dynamics, and he's very funny.
United Center is where it was filmed at. Did you see that?
Yes.
Okay. Shout out
Chicago. Okay.
Yeah, hometown.
Nice.
Love it.
Very nice. Mine is a movie. I love these movies where you sit down in one sitting and you watch it and it's done. It's called Operation Mincemeat. It's got Colin Firth and Tom from Succession. He'll always be Tom from Succession. I actually don't even know what his real name is, but he has a British accent, and he's British. He finally gets to use it as opposed to doing the amazing thing of doing an American accent when you're British, or vice versa. So it's pretty good. It's a buy recommendation. It's not on my conviction list though. So I think it's entertaining enough though. But I'm not asking you to make a big investment here. Just probably 2 hours of your time. So, all right. Well, next week is a short week, and we always say it's supposed to be a slow week. We'll let you know when we know. I don't know what we're going to do about the show next week. We haven't talked about that, but we'll figure it out. Maybe we'll record it early and we'll do some evergreen stuff, but I guess we'll have to discuss that next week. All right, Mike and Shane, thanks again. For everyone else, we'll talk to you next week. See you, everyone.